The "nobody tells you" framing directly activates the betrayal emotion that is the emotional engine of this script. The feeling that the system failed her at the worst possible moment. It also places Cecelia's identity and the CPA call in the same breath as the urgency, which mirrors the emotional sequence the viewer is likely living herself. Version 1 is a strong alternate if the channel's analytics show that dollar-first hooks outperform. It's equally accurate and specific. Version 3 is effective, but opens with a conditional that may not land for widows who lost their husbands in prior years, which is a significant share of this audience. My name is Cecelia Voss. I'm 71 years old. I live outside Knoxville, Tennessee, and I buried my husband Randall in March of last year. I am not a financial advisor. I was an office manager for 23 years. Randall handled most of our money. When he died, I had a binder, a lot of account statements I didn't fully understand, and a very patient CPA named Gerald, who called me 2 weeks after the funeral with some news I was not prepared to hear. I had just bought the sympathy thank you notes. I was still signing them, and Gerald called and said, "Cecelia, I need you to listen carefully, because there's a window closing on you at the end of this year that we cannot miss." I need to tell you what he told me, because what happens to a woman's tax bill in the year after her husband dies is one of the most financially damaging things I've ever learned about, and almost nobody tells you in time. Here is the short version. Your husband is gone. His income is mostly gone too, and the IRS responds to this by charging you significantly more in taxes. Not less, more. They move you from one column of the tax code to a much more expensive column. And if you don't act before December 31st of the year he dies, you lose the one window you'll ever have to protect yourself. I'm going to explain exactly what happened, exactly what I did, and exactly what you should do, whether your husband passed this year or several years ago. Now, I want to say clearly, I am not a tax advisor, and your situation is different from mine. Before you make any of these moves, please sit down with a CPA who knows your specific numbers. What I can do is explain what I learned, so you walk into that appointment knowing the right questions to ask. That matters more than you know. Now, before I show you what to do, I need to make sure you understand what we're actually dealing with. Because until you see the numbers side by side, you won't fully understand why the timing matters so much. I'm not a numbers person. I never was. Randall handled most of this, and when he died, I'll be honest, I sat down at our kitchen table with his folders, and I thought, Lord, I don't even know where to start. But Gerald walked me through it, and once he did, I understood. So let me walk you through it the same way he walked me through it. The tax code has brackets. Think of them like containers. The government says, the first certain amount of your income gets taxed at 10%. The next chunk, 12%, then 22%, and so on. The wider those containers are, the more money fits in the lower percentages before you get pushed into a more expensive one. Here's the part that matters. Married couples get wide containers. Single filers get containers that are about half as wide. In 2026, if you're married and filing jointly, you don't hit the 22% bracket until your taxable income is over $100,800. If you're a single filer, you hit that same 22% rate at $50,400. Same tax rate, half the room. And it's not just the brackets. The standard deduction, that's the amount of income you get to keep before taxes even start, drops from $35,500 for a married couple, both over 65, to $18,150 for a single filer over 65. That's $17,000 more of your income suddenly sitting out in the open, exposed to taxation. And your mortgage hasn't changed. Your electric bill hasn't changed. Nothing about your life got cheaper. The government just moved you to a more expensive column. Now add your RMD to this picture. An RMD is a required minimum distribution, the IRS's way of forcing you to take money out of your traditional IRA every year once you reach a certain age, whether you need it or not. That withdrawal counts as taxable income. Randall's death did not shrink that number, it just made the brackets around it smaller. And here's one more thing Gerald warned me about. Your Medicare premiums can go up too. Medicare uses your income from 2 years ago to decide what you pay now. 2 years ago, Randall was alive. Your joint income was higher. So Medicare right now may be charging you based on a household that no longer exists. I'll tell you how to fix that in a minute. Okay, now you understand the trap. Here's exactly how I got out of it, and how you can too. There are 4 moves. I want to walk through all 4 of them because they work together. But the first one has a deadline, and if your husband passed this year, I need you to pay attention right now. The IRS allows you to file jointly for the full calendar year in which your husband dies, even if he passed in January, even if he was only alive for 1 week of that year. You still get to file as a married couple, filing jointly for that entire year. This is the last time you will ever file as a married person. And here's why that matters so much. It is the cheapest tax rate you will ever see again. Those wide containers, the ones that let $100,000 fit in the 12% bracket, they're available to you one final time. A good CPA will tell you, fill those containers before December 31st. Here's how you do that. It's called a Roth conversion, and I want to explain it simply. A traditional IRA holds money you haven't paid taxes on yet. Every time you take money out, including your RRD, you pay income taxes on it. A Roth IRA is different. You pay the taxes now when you convert, and then that money grows tax-free for the rest of your life. No more taxes on it, ever, and no more RMDs forcing you to take it out. So here's the move. In the year your husband dies, while you're still filing jointly, you convert a chunk of your traditional IRA to Roth. You pay taxes on that amount now, but at the lower married rate. Money you would otherwise pay taxes on later at the higher single filer rate for the rest of your life. Write this down. In 2026, the 22% joint bracket covers taxable income up to $211,400. If your other income, your Social Security, your RMD, totals $65,000, you may have over $100,000 of space at those lower rates. Every dollar you move into that space now is a dollar you'll never pay the higher single-filer rate on again. I sat there at the kitchen table with my legal pad, and I wrote down 2 words: December 31st. That was the number that mattered. Not the dollar amounts, the date. Talk to your CPA as soon as possible about this. If your husband passed this year, you need to have this conversation before the end of the year. Do not wait until tax season. That was move 1. It's the most important one, and it has a hard deadline. Now let me show you the moves that protect you every single year going forward. Here is something most people don't know. Medicare does not automatically update your premiums when your spouse dies. Medicare uses a 2-year look-back. In 2026, they are charging you based on your 2024 income, the year Randall was alive. If that income was higher than your income is now, you may be paying Medicare surcharges you no longer owe. These surcharges are called IRA-to-charity. You don't need to remember that name, just remember this. If your household income dropped significantly because you lost your husband's Social Security check or his pension, you can appeal those higher premiums right now. The form is called SSA 44. It stands for Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event Form. You explain to Medicare that your income changed because your spouse passed away, and you ask them to recalculate your premiums based on your current income. Write this down. The phone number for Medicare is 1-800-633-4227. You can also go to ssa.gov and search for SSA 44. Call them and say, "My husband passed away and my income has dropped. I want to file an SSA 44 to appeal my IRA surcharge." The first tier of IRA costs you about $700 a year extra just in Part B. That's money you should not be paying if your income is lower now. 1 phone call, 1 form. If you are 70 and a half or older and you give money to a church, a charity, a food bank, a hospital, anywhere you donate regularly, listen to this very carefully. You can direct money straight from your IRA to that charity, and the IRS will count it toward your RMD without it ever appearing on your tax return as income. This is called a qualified charitable distribution. The limit in 2026 is $111,000. Here's the practical version. Let's say your RMD this year is $14,000, and let's say every year you write your church a check for $2,000 out of your checking account. Stop doing that. Instead, call your IRA custodian, the bank or brokerage that holds your IRA, and ask them to send a $2,000 qualified charitable distribution directly to your church. That $2,000 satisfies part of your RMD. but it never hits your taxable income. It's like it didn't exist on your tax return. Your taxable income drops by $2,000. Your brackets stay lower. Your Medicare premiums may stay lower. It must go directly from the IRA to the charity. You cannot take the money yourself first. Call your IRA custodian and use the words "Qualified Charitable Distribution." They will know what to do. Every year going forward, Cecelia, and now you, runs one simple calculation. How much can I convert from my traditional IRA to my Roth IRA before I hit the next tax bracket or cross the Medicare income threshold? In 2026, for single filers, that Medicare threshold, where your premiums go up, starts at $109,000 of income. You want to stay under that line if you can. Say your total income this year is $78,000. That means you may have $30,000 of room before you hit that threshold. Converting $30,000 to Roth this year, paying taxes on it at 22%, means that money is tax-free forever. And it means your IRA balance is $30,000 smaller next year, which means your required minimum distribution is a little smaller next year, which means your taxable income is a little smaller, which means your brackets stay a little lower. You don't have to move huge amounts. Even $10,000 or $15,000 a year compounds over time. A smaller IRA means smaller mandatory withdrawals for the rest of your life. Now I want to warn you about a few things, because these are the mistakes that will cost you the most, and most of them happen simply because nobody tells you in time. The biggest mistake: treating the year of death tax return like any ordinary year. Handing it to whoever does your taxes without mentioning the Roth conversion window. That December 31st deadline is not flexible. It does not move. If you miss it, it is gone, permanently. The second mistake: not appealing the IRA surcharge. Medicare will not call you. Medicare will not send you a letter explaining that you're overpaying. You have to ask. File the SSA 44. Make the call. The third mistake: rolling your husband's IRA into your own without thinking through the timing with a professional. A spousal rollover can be smart, but it changes your RMD schedule. If you're older than 73, get specific advice before you move that money. This is not a decision to make with a phone call to your brokerage's customer service line. My neighbor Wanda lost her husband the year before I lost Randall. Nobody told her any of this. She is paying thousands of dollars more in taxes every year than she has to. She doesn't even fully understand why. And when I explained all of this to her, she sat very still for a moment, and then she said, "Cecelia, why doesn't anyone tell you this?" This information should be on a pamphlet at every funeral home in this country. It is not. That is why I'm here. So here's what I need you to take away from today. If your husband passed this year, call a CPA before the end of December. Talk about filing jointly and doing a Roth conversion before that window closes. If you're on Medicare and your income dropped, call 1-800-633-4227 and ask about the SSA 44 form. If you donate to charity and you're over 70 and a half, call your IRA custodian and ask about a qualified charitable distribution this year. Every year going forward, ask your tax preparer one question. What is my bracket fill number, and should I be doing annual Roth conversions? If they don't know what that means, find someone who does. Someone who specializes in retirement income for women living on their own. This is their job. Let them do it. The legal pad on my kitchen counter is getting full. Randall's name is on the front of it. But every page inside is a move I made, a deadline I didn't miss, a dollar I kept. Now you know what the tax code does to widows, and now you know exactly what to do about it. If this helped you, share it with someone who needs to hear it, and subscribe. I put out new ones every week.